we are experiencing a major financial shock. We believe that the Fed is going to be quite surprised. And we believe when history books are written, that economists will be looking back at this saying, wow, what a shock to the system.
This past month has been a wild ride for the stock market. Just last week, both the S&P 500 and the NASDAQ made new lows for the year, and there could be much more pain to come. A few days ago, Michael Burry tweeted that over 13% of stocks closed above their 200-day moving average. At the bottom in 2009, just 1.2% of stocks closed above that average. During the market bottom in 2020, just 2.8%. So by those standards, we're currently at December 2007 levels. And in case you weren't investing during the Great Financial Crisis, the S&P 500 didn't bottom until 15 months later, in March of 2009, after going down another 50%. So we could still have a long way to go. For the record, I'm not saying that we should expect the market to drop another 50% right now. I'm just pointing out that this most recent rally may not be the end of the current bear market because everything causing it hasn't really gone away yet. The escalating war between Russia and Ukraine, the tensions between China and Taiwan, the lingering supply chain issues, winter about to raise the demand for oil and gas, oh yeah, and everything going on with Credit Suisse and their credit default swaps. And if you're not into global events, how about the combination of rising interest rates in the US and weaker than expected earnings for almost every US tech company, especially when comparing against numbers from the pandemic. But there is one person taking on the other side of this bet. Her name, Cathie Wood, and her stance is that deflation is already making it through the economy as commodity prices come down, inventories pile up, and retailers get ready to slash prices for their biggest holiday sales. Here's Cathie Wood laying out her expectations during a recent interview on CNBC's Tech Check.
Cathie, good to see you, and thanks for coming on with us. Let's start broad. October is certainly off to a strong start, and it feels like the bulls are hoping that the Fed may not be as aggressive going forward, something that you've repeatedly called for. That sentiment did underpin the summer bear market rally, but ultimately led to new lows. What is your read of the moment of market sentiment?
Well, interestingly, our strategy did not hit new lows, our flagship strategy. And that is quite normal toward the end of a bear market. Innovation tends to be the new leadership as we move out of a bear market. And if we're right and the Fed's close to pivoting, whether in rhetoric or otherwise, and they have a lot of reasons to pivot, even more now after the LDI crisis in Europe. We may have something similar going on here in the United States. And we also have big deflation in the pipeline. Just one commodity price after another has been capitulating. So that's at the beginning of the pipeline. And then at the end of the pipeline, we have inventories overwhelming companies. And we have a consumer that is not playing ball as much as he or she was before. So we think this holiday season is going to be quite tough and is going to include a lot of discounting. We believe that the Fed is going to be quite surprised at the deflationary pressures that start hitting the headline inflation numbers during the next 3 to 6 months.
So Cathie Wood's stance is basically the opposite of Michael Burry's. She thinks that inflation will hit a steep decline as these deflationary forces make their way into the PCE and the CPI. Once those price indexes start to drop, the Fed will change their tune and stop raising interest rates so aggressively. And when that happens, growth stocks stand to gain the most, since their market caps are priced further into the future. Growth stocks, like the kind that Cathie Wood's ARK Invest funds exclusively invest in. Let me know who you agree with in the comments below. Do you agree with Michael Burry and think that there's much more pain to come for the markets? Or are you siding with Cathie Wood and think that we're almost through the worst of it? Whoever you side with, it's a good idea to know what they've been buying and selling accordingly. Let's start with Michael Burry. Back in Q1 of this year, Michael Burry held 11 stocks, including some big names like Apple, Google, and Meta Platforms. These are the same companies you'd find near the top of the indexes. But if he really believed that there was so much more pain coming for the stock market, wouldn't he sell all of these positions to protect himself and his investors? Well, actually, that's exactly what he did. By the end of Q2, Michael Burry literally sold 100% of his holdings across the board. Apple, Google, Meta Platforms, everything. He now only holds one position, and it's in the Geo Group, a private prison operator. To me, this stock actually looks like a pretty mixed bag. For example, we can see that Geo trades at around 45% below their calculated fair value, at least according to Simply Wall Street's built-in discounted cash flow analysis, so Geo Group stock could be a decent buy if you focus on the long term. They also trade at a very reasonable forward price to earnings ratio compared to their peers and well below their industry average. But the stock also comes with a few big red flags. For example, their past return on equity, return on assets, and return on capital are all at or below average for their industry. Their financial health is also pretty weak, in part because they have a high amount of long-term liabilities compared to their assets, and a very high debt-to-equity ratio overall. So even if you're sure that Michael Burry is right about the market, at least in the near term, I wouldn't run out and buy the stock right now. My main point is to show you just how serious he is about his prediction. Serious enough to sell hundreds of millions of dollars worth of positions in some of the best tech companies on the planet. Unlike Michael Burry's hedge fund, Scion Asset Management, which reports their holdings quarterly, we can see what Cathie Wood's ETFs over at ARK Invest are buying and selling day by day, since they report their holdings before every market open. So what I've been doing is grabbing ARK Invest's holdings data every day and looking for changes and trends over time. Let's take a look at how ARK Invest's top holdings have changed from the start of September through today. Here's a table of ARK Invest's biggest position changes when you combine Cathie Wood's 6 actively managed funds. Each row is one company, the rows are ordered by the size of Cathie Wood's position in that company, and each position is colored by its change in size since the start of September. Positions colored in green grew relative to the rest of the funds, and the positions colored in blue shrank. Keep in mind that there are 2 ways for Cathie Wood to increase the size of a position. She can either buy more shares, which is shown in the change in this first column, the change in shares column, or she can hold shares instead of selling them as they go up in price, which obviously grows the size of the position, but adds in the risk of the stock going back down if her call about the Fed pivoting doesn't end up coming true. That change in price is the second column. Now that we're clear about what all the columns of the table mean, let's take a look at what stocks Cathie Wood has actually been buying as she expects the Fed to lower interest rates. To see that, let's sort the data by the change in share count. So here's what the opposite side of Michael Burry's prediction would look like. The top 3 growth stocks that Cathie Wood has been buying are Nvidia, ticker symbol NVDA, Uipath, ticker symbol PATH, and Ginkgo Bio Works, ticker symbol DNA. Let's go through them one by one. Cathie Wood almost doubled her share count in Nvidia stock over the last month. Nvidia designed some of the most advanced chips on the planet for graphics processing, data centers, supercomputers, and edge devices like laptops and self-driving cars. Cathie Wood is betting big that GPUs and AI accelerators will replace standard CPUs, like the kinds made by Intel, inside enterprise data centers. Nvidia also has a huge initiative called Omniverse, which is a suite of tools and software connectors that let other companies build digital twins of their physical assets. This enables everything from optimizing layouts of factory floors and warehouses, to training machine learning and AI models, to having huge teams collectively build out a large 3D environment for a movie or a video game or a big engineering project. But it's not all sunshine and rainbows for Nvidia. Their stock price has been crumbling pretty much all year, coming down over 50% year to date and over 30% over the last couple months alone. Last quarter, the revenue from GPU sales dropped by 33% year over year and 44% quarter over quarter. That decline is expected to continue as crypto miners not only stopped buying Nvidia's GPUs after the Ethereum merge a few weeks ago, but now they're going to sell their own used graphics cards on the secondary market, effectively undercutting Nvidia's future sales. If we go back to Simply Wall Street, their discounted cash flow model suggests that Nvidia's current share price could be pretty undervalued. Nvidia may not be a 10 or 20 bagger, but it's in a good position to provide healthy returns in excess of the market. If we look at their future growth potential, which is what Cathie Wood focuses on, Nvidia meets 5 of 6 Simply Wall Street checks by having high earnings relative to the savings rate and the rest of the market, having high growth earnings, healthy revenue compared to the average stock on the market, and a very high forecasted return on equity over the next 3 years. The one check that they don't meet is high revenue growth in the near future, thanks to that drop in GPU demand that we just discussed. The next company on Cathie Wood's list is Uipath. Uipath went public about a year and a half ago and has been moving down and to the right ever since. It's down over 80% from its peak. Uipath is a software company that focuses on RPA, or robotics process automation. The enterprise RPA market is just beginning and will be growing for years to come. Uipath builds software robots that manage simple but repetitive workflows like invoicing, email filtering, data gathering and entry and formatting, stuff that we all do over and over again at our jobs. An example workflow for Uipath's bots could be parsing emails for data and entering all that data into a bunch of other forms and applications, like into a help desk ticket. One special thing about Uipath is that their bots use computer vision to identify on-screen elements like buttons, text boxes, and form fields, which means that they can do their job even if a website or an application changes its interface over time. Uipath has developed an entire suite of tools for building and managing these bots, not just the bots themselves. Let's take a look at Simply Wall Street's analysis for Uipath. There seem to be some notable issues for this stock. For one, Uipath seems to be trading much closer to its fair value, at least from a discounted cash flow point of view. There are 19 analysts covering this stock, and their 12-month price target has been steadily declining from $76 per share all the way down to $17. They scored just a 1 out of 6 on Simply Wall Street's future growth checks because they're expected to remain unprofitable for the next 3 years, and provide a low return on equity to investors as a result. Uipath has a great suite of RPA services and a huge total addressable market, but the stock itself comes with a lot of future risks, especially in today's market, which punishes unprofitable growth companies. Even though I personally like and use Uipath's services, I would keep the stock on my watch list for a little while longer before buying any more shares on the dips. Uipath is ARK Invest's 4th biggest position overall, and Cathie Wood has around $600 million in it across her combined funds, so this is a very high conviction position for her. Another company that Cathie Wood has been putting a lot of money into is Ginkgo Bio Works, ticker symbol DNA. Ginkgo Bio Works is ARK Invest's 14th biggest position overall, with over $400 million in it. Ginkgo Bio Works uses genetic engineering to make microorganisms for different industrial applications. Their platform really has 2 parts: their code base of cells, enzymes, and genetic programs to jumpstart new projects, and their automated foundries, which are the physical labs and machines where these custom cells actually get made at scale. The list of end markets that their platform can serve is massive. For example, they can help make next-generation antibiotics, make more resilient crops, or design custom enzymes for new applications altogether. They're able to work in many different markets because their platform focuses on the thing that all these markets have in common: reading and writing the genetic code of the underlying cells. That means Ginkgo's customers don't need to build their own labs and teams of bio and chemical engineers. Instead, Ginkgo Bio Works helps these businesses by removing bottlenecks in their production lines. For example, a company wouldn't need to raise animals to get hemoglobin or plants to extract CBD oil. Growing plants and animals is a more expensive, more time-consuming, and much less scalable process than reprogramming yeast to make these things, which is one way that Ginkgo creates specialized microorganisms at scale. Ginkgo Bio Works' stock actually has a good amount going for it. It's trading over 40% under its fair value, giving it plenty of upside given its current cash flows. Their revenue is forecasted to grow by over 30% per year and grew by a whopping 305% over the past year. They also have a very healthy financial position, with over $1.6 billion in assets and less than 1/10 of that in short-term liabilities. Oh yeah, and no debt. They also have a good cash runway of much more than 3 years, which means that they're in a good position to not rely on higher interest rate loans if Cathie Wood's theory on interest rates coming down doesn't pan out as she expects. But again, that doesn't mean that you should go out and buy this stock right now, especially if you agree with Michael Burry's point of view on the market over the next 6, 12, or even 18 months. Ginkgo Bio Works isn't expected to be profitable over the next 3 years. The stock has also been very volatile over the last 3 months, being up around 20% since the start of September. So I would put this one on my watch list again, and then wait for the volatility to bring in more favorable prices. And by the way, if you did want to try out Simply Wall Street, I'll leave a link down in the description of this video. It's free to use forever, but if you do want to sign up for a premium account and get all the features that I've been using to make this video, then you can get a 40% discount by using that link as long as you're one of the first 100 people to use it. Thanks to Simply Wall Street for that awesome exclusive offer. So, here we are, 2 very high-profile investors with polar opposite views on where the market is heading and strategies for making the most of it. Michael Burry thinks that we're in for much more pain, and he sold all of his holdings except for one. Cathie Wood thinks that we're almost out of the danger zone, so she's been loading up on the very growth stocks that have seen massive declines over the past year. Let me know in the comments below which side you're on, and which stocks you're watching right now as a result. If you want to know which stocks I'm watching right now based on my own research, check out this episode next. And if you feel I've earned it, consider hitting the like button and subscribing to the channel, which lets me know to put out more research like this. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.